real estate investment, mortgage payment patterns. Get ready because it's time to raise the stakes with real estate. We're going to start off with a loan example. Example data being that we have the loan amount of the $100,000, the years at 30 years, the rate at the 7%. If we calculate the monthly payments, we would have $665.30. So in other words, we'd be paying monthly $665.30 for 30 years on a monthly basis. In other words, 30 times 12 or 360 months. At the end then of that full term, we would then have the loan balance go down to zero at the end of that 360 months. So if we were to amortize this, and I highly recommend working the amortization tables, but when you're looking at a loan that's 30 years out and it's on a monthly basis, meaning 360 periods, it can be quite daunting to kind of see what's actually happening over the extent of the loan. But it's important to have a grasp of it so you can see what's happening at the front end and the tail end, especially when you have to consider taxes as well that could be imposed because the tax benefits might be related to, in essence, the interest portion of the payments made. So in other words, we can see that we have the payment. We took off the pennies here, about 665. That remains fixed throughout the term of the loan for the whole 360 periods. And then the breakout between the interest and the reduction in the loan is going to change. This is kind of the sacrifice of us having this even payment. This nice even payment means that we're going to have this breakout or this difference between the interest and the loan reduction portion. So what we have here is we could see that we have the $100,000 of the first payment. We have the payment that's going to be fixed at the 665. The interest is calculated at about, we took off the pennies, 583 here. So that's going to be what the interest has accrued to be. We're making a payment that is greater than the accrued interest, and therefore the difference between the two is the reduction in the loan. Therefore, the $100,000 goes down, the balance of the loan. We don't owe $100,000 anymore, but it doesn't go down by the payment, the 665, but rather the amount of the loan reduction after taking into consideration kind of the rent on the purchasing power, or in other words, the interest, goes down to 99918 here. Now, as we go down, it looks pretty much the same for the second payment, but what's really happening is you're making the payment on just simply the reduction in the principal amount here, which doesn't have a big impact at the beginning of the loan, but you can see as time passes, you have this difference between the interest and the loan reduction with the payments being the same, meaning the interest as time goes starts to go down, the interest portion that you're paying, and the loan reduction amount that's going to be the portion goes up. So the loan, you're paying off more of the loan as time passes, even though you're making the same payment, and you're paying less interest as time passes, even though you're making the same payment, due to the fact that you're only paying interest on the balance of the loan as the time passes. So again, this will become more apparent if you do practice problems making amortization schedules, but this becomes a very extreme difference when you look at the very beginning of the loan and the end of the loan, especially for these very long loans. Up towards the beginning, of course, most of the payments are interest. When you take into consideration taxes, that's usually where you get a benefit too on the interest. You don't get the benefit on the reduction of the loan. Therefore, at the front end of the loan, you get kind of more of that tax benefit. And then at the tail end of the loan, you're going to see a lot more of the payment, the same payment being applied to the loan reduction and far less being applied to interest. Now, if you were to kind of graph this out, it would look something like this. If we were paying the 665, which is around right here on this graph, this is graphing the interest. So this green line, kind of a line, that thing would be, we're going to say that that's going to be the amount of the payment. And this blue line represents the interest portion of the payments that we're going to be making. So the payment is fixed, green line, interest portion, blue line. And then down here we have the time in months, which would be 360 months here. So we're saying, okay, if the payments then are going to be made, the breakout between the amount that's going to be interest, blue line, and principal will be broken out. So right here, if we say, okay, 100 payments in, we're saying that this represents the interest portion of the payment, and this represents the principal portion of the payment. So when we made the first payment, you could see basically that most of it is going to be on the interest side and very little on the principal. And then we've got more on the principal, unless this is an I, less on the interest. And then here, of course, 200 payments in. More of that payment, the 665, was it? 665 is going to be going to principal, same payment amount, but now you have far less going to interest. And then, of course, when you get down to the tail end, like 300 and 300 payment, it goes up to we have the 360 payments because it's going to be the 30 times 12. And so here we got the interest portion, and far more of the payment is going to be principal, which again could have a tax impact depending on what your real estate is. Now you have a similar kind of thing with the loan balance, of course. If up here we took out the loan for the 100,000 in terms of the loan, and as we make the payments, the loan balance is going down, but it's not going down in a straight line due to the fact that the loan balance is going down, relative to the payments that being made and the breakout between the interest and the principal. So in other words, you could see down towards the end of the loan over here, you're going to end up having each payment decrease in the loan by a larger amount as you get to the end of the loan, because at the beginning of the loan, all the payments that you're making, most of the payment is going to interest at the beginning. And at the end of the loan, most of your payment's going to principal. So if you were to graph these two together, you'd have these similar kind of curves here. This is the payment that we made, the line here, 665, the breakout on the blue line being the interest versus the principal, and then you see the loan reduction. So you don't get this straight line, you get this basically curve line that's happening over time. Again, that kind of has implications in terms of the loan balance that's going to be outstanding, and it could have tax implications that you're going to consider over the life. The other thing to look at here, this is going to be the loan, the 100,000. We're going to keep the rate the same at the 7% and say, well, what would happen if we change the maturities? Meaning the standard 30-year, we got the standard 30-year, which would be 360 payments, meaning 12 times 30, 360. What if we went up by intervals of 60? What if we took the loan out for 60 versus plus 60, 120, plus 60 would be 180, plus 60 would be 240, plus 60 would be 300, plus 60 would be the 360 being the 30 times 12, meaning the 30-year mortgage. So we're saying, okay, the maturity, we're just going to increase by intervals, even intervals of 60. The 60, if we take the 60 divided by 12 months, we're taking intervals of basically 5 years, right? And so if we look at that and we graph it out and we say, okay, well, what's going to be the impact on the payment? So we calculated these payments, and we'll do these calculations in practice problems in Excel. So if we know this information, if we know the loan is 100,000, the rate is the 7%, and we're saying it's going to be a 60 period, 5 years, 60 period, we can calculate the payment, which would be the payment necessary to have even payments over that 60 period amount for the end then to pay off the interest and principal and result with a principal balance of 0. You'd need a payment of $1,980. And then if it was a 120 maturity, same rate, loan amount, then the payment would be going down. That's going to be the point. If you extend the period, then you can have a reduction in the payment. So that's one reason that when we think about the home loan, because people are purchasing or having a large amount that's financed oftentimes, one way to get the payment down is to extend the maturity. Obviously, when you extend the maturity, then you're going to be paying more interest over the life because you're going to be basically paying rent on the purchasing power over a longer period of time, but it lowers the payment amount. That's in essence the trade-off. And then if I go to 180 period, so 7%, $100,000 loan, 180, the payment goes down to $899. If I go to 240, then 7%, 100,000, 240 periods, the loan goes down to 775. If we go to 300 period, 300 months, then the loan amount goes down to the payment goes down to 707, same rate, same loan amount. And then if we go to the 360, which is the 30-year, at the 7%, 100,000, we've got the payment amount at the 665. Now, note what happens here is the difference goes, even though we have the same intervals of 60 periods, 5 years that we increased by, we've got the change that doesn't change by the same amount, right? So first we had the payment of the 1,960. So if I go from a 5-year, a 60 month to a 120 month, then we have a pretty large change in the payment amount. 1,980 minus the 1,160, we've got about 819. There's rounding 820. But then if I go from the 120 and have another 5-year interval, 60 months, to 180, the change then that we're talking about goes from the payment, which would have been 1,161 minus the 899. So there's still an impact in the difference in the payment, but the impact is going down, right? And then if I go from 180 and I extend the maturity and say, well, how low can I get the payment? If I then go to the 240, lengthening the loan, well, then the payment was 899 minus 775. Then there's a change. It went down by the 124. So it's going down, but by less here. So, and then if I did it again, we're going to go from 240 up another 60 periods to 300. What's that do to the payment? Well, it was at 775 minus 707. So now it's about 69, 68 rounding change. And then finally, if I go from 300 periods to 360, it's going from 707 to 665 or 41 or 42 about. So if we graph that out and we say, okay, what is the impact? If I was to say I want to pay this off in a short period of time, the trade-off is if I can pay it off in a short period of time, like 60 months, 5 years, then that would be great because I would be paying less interest overall, given the fact that I wouldn't be having this longer time frame and I'd pay less interest over the time period. As opposed to if I have a longer time frame, like way down here at the 30-year, that's the trade-off being I have a less amount of a payment amount, but obviously I'm going to be paying more interest because I've got the loan out for 30 years or 360 months. And you can see the curve as you extend the maturity, keeping the loan amount the same and the interest rate the same, as it basically flattens out the payments then being over here. Here's going to be, if you had just the 60-month time frame, around the 1,980, and then at the 120 here, you got the 120. So you have a fairly steep difference going out down here. And then if it goes to the 180, you could see it start to shallow off in terms of the maturity and the payment difference, and then it kind of flattens out as you extend the maturity, it having then a lesser impact as you extend beyond a certain point being the point. Now, keeping this in mind, you might then think when you're extending the maturity, you might say, okay, it would be nice if I can go for the longer maturity, like a 30-year, and still have the option of paying it off earlier. So I might be able to say, and you want to make sure you could see that the loan is structured in such a way that you could make early payments. And if that's the case, then you could kind of have the best of both worlds and saying, okay, I have a payment that I'm sure I can make and possibly have the option of paying off and making the earlier payments. And then you might get the benefits on both sides. So you'd want to make sure that the loan is structured in such a way that that could possibly be the case. So the general idea, extending the maturity generally lowers the payments. The trade-off being you're going to be paying more interest over the term of the loan. And again, you might be able to decrease the payment with a longer, but that benefit is not as great as you keep on extending the loan. And then, of course, you might think about the idea of having, can I have a lower payment, the payment as low as possible, while still having the option to basically pay it off sooner and kind of have the benefit of being able to pay it off sooner, as well as the security of having the lower payments if I need to make the lower payments.